You're about to join Niels Kostrup Larsen on a raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Series.
Welcome back to this week's edition of the Systematic Investor Series with Nick Baltas and I, Niels Kostrup Larsen, where each week we take the pulse of the global markets through the lens of a rules-based investor. Nick, it is great to be back with you this week. How was your summer? Hopefully not too hot where you went.
My summer was good. Hi, Niels. I was in Greece. Obviously, Greece was very warm. It wasn't not as hot as it was in July. I happened to be in London at the time. But it was beautiful. Family, friends, some summertime, island life. It's beautiful. How about yours?
Sounds pretty nice. Yes. So I've just been sort of in and out between Denmark and Switzerland this year, but it's been pretty good as well. Can't complain. Now, we've got a pretty solid lineup of topics that you brought along, and we also have a question that we should tackle today. Before we do that, I actually always try to remember to ask you kind of what's been on your radar, not related to the topics we're going to talk about, but kind of other things that you have found interesting in the last few weeks since we last spoke. Anything springs to mind at the moment for you?
I mean, obviously September came back. We came back from holidays, and we start seeing increased activity as our clients get positioned towards the end of the year. I would say the optimism and the kind of risk-on mood we saw in the earlier part of the summer is now kind of moderated with some demand for a bit more kind of defensive stance. It's a good question as to whether this soft landing is coming or we're going to see like a bit more stubborn rates for a bit longer. And you see a bit of a pendulum between is interest rate uncertainty going to kind of normalize as much as we have been wanting or have been expecting? Is it still a kind of a carry-seeking opportunity because we tend to see a lot of our clients looking into kind of carry trades, whether that is in the linear space or in the vol space. There is this kind of yield enhancement kind of appetite. Obviously, diversification is still on people's minds, so we see now big institutional investors kind of going back into those multi-strat constructions that blend carry sources, some sort of defensive sources. So I would say there's fairly balanced appetite in the present moment for the profiles that we typically look at. That's probably like the quick reflection from the last, I would say, 2 weeks that I've been back from the August break.
Sure. No, that's pretty interesting. Good stuff. All right. Well, as a quick trend following update, my own trend barometer finished yesterday at 45. So although that's still pretty neutral, it has been rising recently. And I think that's also reflected somewhat in the performance numbers that I'm going to share in just a minute. Overall, there seems to be pretty broad-based attribution. Nothing that kind of completely jumps out of the screen, but it looks like we both have sort of some wins on the fixed income side and also the energy side, and those are big sectors, so they can certainly make a difference in performance. So far, and this is as of Wednesday, because I don't think that we have the numbers from yesterday, 1.95% up for the month of the BTOP 50 index, which means it's up about 1.6% for the year. The CTA index, SocGen CTA, up 2.25%, up 0.5% for the year. The SocGen Trend Index up 2.4% for the month, and it's flat now for the year. And the Short-Term Traders Index up about 70 basis points, but still down 2.7% for the year. Equities, MSCI World, flat for the month, still up 14.6% for the year. Government bonds, not doing so well again, down 70 basis points so far this month. And the S&P 500 is flat for the month and up 17.34% so far this year. Now, before we dive into the topics, I wanted to just ask you this question, Nick, that came in from Corey. Now, I seem to remember that we may have answered this before, but I'm not sure. So therefore, out of courtesy to Corey, I want to bring it up just to be absolutely sure. And the question is, if an investor is heavily weighted equities, as most people Are they better off with trend-following providers that don't include equities as one of the utilized asset classes? In the short run, in a big sudden negative equity move, it seems that the answer is logically to be yes. So your trend-following allocation isn't caught long, but over the longer period of negative equity returns, being able to be short equities could be a positive. Has this ever been studied or analyzed? ? Thanks so much. Love the show, Corey. All right, Nick, quick thoughts on this before we dive into the topics. What are your sort of views on this question?
Yeah, it's a question that comes along quite regularly, I would say, in the sense that I'm holding my equities portfolio alongside other parts of the asset allocation, and adding an alternative source of return that being trend following obviously brings up the question as to whether I would want to overload equities on an upstream path. In other words, should I be long in my asset allocation, which I anyway am, and then still in my alternatives? So should I just reduce this participation in equities on the upside? Which is a fair point to be made, but completely taking out equities out of a trend program, I think it's now going against its ability to provide convexity on the downside. So to the second part of the question, with negative equity returns, which typically happen alongside volatility spikes, and they tend to persist for some time, this is precisely when you'd expect a trend follower to be able to deploy those short exposures in equities. Surely we can talk about how growth risk is propagating across other asset classes and how convexity can come along from your bonds exposure, so on and so forth. But still having a short equity exposure within a trend system alongside a long equities exposure on the SAA is going to provide this defensiveness around challenging markets. So I think the question is not, at least in my view, whether we should have equities or not. It is more about whether the equity participation on the upside should somehow be controlled by some form. There are various ways one can do it. We can control the overall beta to equities. You can control, the outright exposure or the net exposure. There's various ways, and I believe there's a paper from, it's from AHL, that is looking into different ways of achieving additional defensiveness versus equities. Obviously, there is a cost to pay, and that cost to pay is the participation on the upside, and the fact that equities historically obviously have been compensating the investor by the equity risk premium, which is harvested by taking those long exposures. I think the last point that I would make is that the transition from being net long to net short is also a feature that trend following systems deploy. So whether one has a kind of reduced participation on the upside or has a faster signal, at least from the perspective of defensiveness versus kind of carry cost, would probably give a very similar answer over the longer term. Whether you're fast or reduce your upside participation, it's relatively similar statistically wise, right? There's other things that one should consider about the design, but at least from the outside, just looking at the stats, should be similar.
I think that's very well laid out, Nick. And I just want to add one small thing, and that is, I feel I've said exactly the same not that long ago. This is why I'm suspecting we may have answered this question before. But anyway, what springs to mind for me is also that because many large managers use correlations as an important part of managing their risk, if you pull out equities, it changes the dynamic of the portfolio, and it actually might lead you to take different positions, certainly different exposure in other asset classes, and therefore people might think about this, I might lose some money on equities if it turns and I'm long, sure, but you might be allowed to have more bonds or more something else in the portfolio that's going to make up for it. So it's not an easy conversation. And this is also why I'm a little bit skeptical with the trend we see, pardon the pun here, the trend we see in our industry where you allow clients to design their own portfolio saying, you can have this building block and this building block and so on and so forth, because they may not see all the various relationships and effects these things have. So I don't want to get into a big debate about it. This is just my kind of two thoughts that I wanted to add.
I think that the last sentence I would put, just because you mentioned it, I think now that kind of brings me a bit of a deja vu because I think we've discussed it. But anyhow, I think if there's an active decision to reduce participation on the upside, there's another consideration to be made with regards to that risk that you would, in principle, deploy on those long exposures. What do you do with it? Allocating that in other assets or other asset classes is very likely to create concentration risk in another pocket of the portfolio. So then the question becomes, in the lack of participation, should I just reduce my overall risk at that time as a function of how much risk I'm not actually deploying that I would have anyway had?
Nick, people are going to go back and listen to our last conversation and see if we answered it the same way, because I have a feeling it was you and I, but there we are. Actually, it sets us very nicely up for today's episode and one of today's big topics, because I think you and I are going to talk about one of the biggest challenges that investors are facing around the world. But we're also going to discuss what the secret to trend following may be, in fact, based on a paper from our friends over at Transtrend. But as usual, I may not have read the papers as closely as you do, but I will do my best to keep up. Now, before we dive into this, what I call this very important topic, which is, by the way, stock-bond correlation, which I also seem to see coming up much more in the papers and the press we see at the moment. I was wondering if you could share your thoughts on a point that Andrew made last week on how model portfolios may find significant value add from trend following, and because this is why he believes that the AUM of the industry might get a massive boost going forward. Now, I have been hoping for that for 35 years, so I'm not necessarily sure that now is the time, but it could be. So I wanted to hear your thoughts about it.
So the point that Andrew made, it was like this 2-foot stool or something like that. I mean, he gave like a very nice analogy. Effectively saying that you have your equities and bonds, but the whole thing just doesn't balance if the correlation between the two is positive. And obviously we have had decades or centuries of equity bond positive correlation, which obviously in the last 20-30 years with the Fed action and the falling rates has turned into a negative sign, which by the way in our lifetime pretty much has been the status quo. We've seen those equities and bonds diversifying each other, bonds acting as a diversifier on equity downturns and so on and so forth. What happened obviously from 2021, 2022 onwards was that inflation spiked significantly, hence causing that correlation not necessarily to break, but go back to the historical positive numbers. And here we are kind of debating as to whether this is going to stay, whether this is either the new norm or the return to the old norm, or this negative equity bond correlation will just come back. Now, as long as this positive correlation stays in, then we have less diversified model portfolios, more risky portfolios, and then question comes, what is the next diversifier in this whole structure that can allow us to maintain, returns and risk at reasonable levels? And I think the point that Andrew was making is that trend following and CTAs is basically what is going to fill that gap. And that's the third foot in this tool to make the whole thing balance out, right? I think that was his point. I think the hypothesis here is that this correlation is not going to flip around into negative numbers, but whether that might or not be the case, and I think that's that's more for economists to opine and possibly for us to experience in real life. What I would say is that we have seen historically that this contribution to performance and to risk reduction from trend followers has been quite substantial. And I think that comes primarily from the fact that you're allowed to short and you're allowed to actively move your positions from long to short and deploy your risk as a function of the overall tradiness in the markets. So I think the good example here is we're talking about 2022 and then 2008. Two good years that seemingly trend following did well, but the driving sources are so different. And the positioning has been so different. In 2008, it was more about shorting equities, shorting commodities, going long bonds. Whereas last year it was basically a different mix. Shorting bonds, long the dollar, going long commodities in the beginning of the year. So the point that I would want to make is the following: the diversification has been tested in various environments. With either positive or negative correlation. I think I agree with Andrew that model portfolios should and will soon, hopefully, introduce this sleeve not anymore as an alternative sleeve, but more as an essential sleeve. By the way, I think that's another thing we have talked, we discussed about in the past, how essential trend following should become. The question is how much, and that brings me back to some work we did about 4 years ago. We wrote a report here at GS, and the title was something like "How much should you allocate into trend following?" And I can kind of talk you through a bit the results because they were quite interesting. So obviously we said, okay, this is trend following. This is like a model portfolio, equities, bonds. Pick your SAA that you prefer. If you look statistically between the two, with any form of asset allocation kind of methodology, let's say mean variance, for example, or some sort of maximum diversification, or whatever that might be, trend following itself, would get a significantly larger allocation than 5 or 6 or 10%. It would be more like 40 and 50 and so on and so forth. Obviously, because historically has had a sharp ratio and downside characteristics that are better than just being holding equities and bonds. But I think the pivotal moment here in how much we should be allocating into it and how we look into it is how, as investors and obviously institutional investors, having the duty to deliver returns for their policyholders, is how much from a career risk perspective can they deviate from a status quo, right? So if a 60-40 portfolio is what we all think as a model portfolio, then me deciding upon a 30% trend following allocation would make me move away from the pack. And obviously that's a tracking error, and that tracking error is equally the risk, out of which obviously we expect the reward, but on the downside we have to have a narrative around it. So I think the big debate now is to whether this tracking error is no longer tracking error because we're actually changing what we're going to compare ourselves against. And that would possibly be, if that is what Andrew is all about, a 60-40 that is multiplied by 80% and therefore shrinks a bit, and then another 20% is becoming trend. So I think where we are at this present moment is that all those alternative allocations, and I think trend following is a good example here, are seen from an allocator perspective as tracking error in a way to what they should be holding rather than bringing it in. And I think that is the moment that likely, to I guess to your aspiration or Andrew's aspiration, it will just jump over and become essential. And if that is the case, then the story is very different, right? But would the correlation stay positive?
Well, that's kind of the big thing
question,
we're going to dive into now. That's the next big report from our friends over at AQR. Before we dive into that, though, let me just say that one thing that puzzled me many, many years ago about allocations from institutions and other fiduciaries is this fact that when you have so much hard data about the positive impact that trend following has on pretty much any portfolio, and I think we can say that with 5 decades of actual returns, that's pretty convincing compared to many other strategies that have not been around that long, but is very popular. I was kind of thinking that maybe one day the tide would turn, that you could get into trouble for not allocating to trend because the evidence is so strong towards the positive impact. Now, maybe that's a bit of a fantasy I have to live with for a while longer. But you have to hope sometimes that, rational thinking may prevail at some point.
We say the same thing, right? Because your point is that if you're penalized for not being there, it's almost as if it becomes part of the model portfolio, in a way. So not being there, you're actually not creating tracking error versus that new paradigm.
All right. As alluded to, we are going to discuss a paper written by our friends over at AQR called A Changing Stock Bond Correlation. And I quote just from the beginning, just to kind of warm you up, Nick, because it's going to be over to you in a few seconds here. It reads, for most of the last 100 years, equities have served as a dominant return generator in many portfolios, with bonds as the chief diversifier. In the last 20 years, however, the relationship between the two asset classes have been quite different from early history. And with that, Nick, let's dive into some of the things that are maybe a little bit more deep than just thinking about stock-bond correlation as a headline kind of thing.
That is also another topic I think that was discussed last week briefly on the equity bond correlation, and that's also a topic that over the last, I would say, 2 years or so, we have looked here, with my colleagues, and we've done work around inflation and growth and how those kind of create different return and risk dynamics for us allocators. The equity bond correlation has been in the center of, as we said, asset allocation for decades, and I think our memory is quite short because we do remember those years whereby Fed action and falling interest rates had caused that correlation to effectively break from the historical positive standards. So what this piece of work is about came out beginning of this year. I believe AQR had that published in their own website probably mid last year. How asset classes perform across different inflation growth regimes, and more importantly, how equity bond correlation kind of relates to those relationships. Eventually, they published this piece of work, I believe, at the Jump Portfolio Management earlier this year. It goes about, obviously, the equity bond correlation. And they start by, obviously, witnessing historical data, suggesting that for centuries, they have data since the 1900s, so a century plus, this was positive. And this was positive up until the early 2000s, that turned negative. And by turning negative, we have had this, Goldilocks period where both equities and bonds have been performing well. And we've had this very, easygoing, but, well-diversified portfolio in the asset allocation. There have been some short-term spikes, like, for example, in taper tantrum. But setting that aside, it has been a strong negative correlation between the two, up until obviously last year that we saw this substantial sell-off between equities and bonds. So they want to understand a bit more, what is driving equities, what is driving bonds, and how this relationship between the two shifts between positive and negative territory as a function of growth and inflation. So they go about looking into historical data, rising growth, rising inflation, falling inflation. What you end up seeing is that stocks and bonds are much more connected, obviously, with growth, whereas bonds are much more connected to inflation. So obviously, we know with falling inflation, both of them perform. With rising inflation, both of them underperform. But obviously, bonds would pay a higher cost to it. Whereas with growth, rising growth, it's typically good news for stocks, but not necessarily for bonds, and vice versa on a falling growth scenario. This, however, if you effectively break it down, gets you to a point whereby the correlation between the two, and that's also kind of related to some of the work we have done here with our research colleagues, the correlation between the two is effectively lower when the inflation stays below some sort of level. It's not 2%, is it 3%? It's the level beyond which the economy becomes overheated, unsustainable anymore, and therefore we have a shock, obviously, in the nominal prices for bonds, as well as in the equity market, and the correlation between the two turns positive, and you have the classic stagflation environment. So this is more or less what they're trying to say, and then they go into the details. What are the news in terms of growth shocks or inflation shocks that make either equities or bonds behave in a particular way that gets us to a point whereby that equity bond correlation becomes primarily positive when you have more dominant inflation shocks than growth shocks.
Can I ask a question here? So I think inflation has been on everybody's mind for the last 2 years. And one of the things that obviously is being debated is, are we facing now a period of structural inflation, which I'm probably a believer in. I don't think we're going to go back to where we came from. Now, one simple way of maybe highlighting why that may cause the correlation to shift, if we were just trying to isolate it, or I'm trying to isolate it to make it clear. I mean, one could say that it changes how central banks can navigate and operate and manipulate. I was wondering whether you agree with that, or whether there are other factors that you see that structural inflation also Because as you said, when you go back these 100 years plus, it is quite telling that when you hit that level around 3% inflation, interestingly enough, correlations are pretty much consistently positive. And it doesn't take much in my imagination to think that 3% would be kind of the low level of inflation we're going to see for a while. So I do think this is why to me, this conversation topic is one of the most important ones investors has to deal with. Whether we are right or wrong, but regardless, I think it's really important.
I mean, the 2% is a bit of anchoring, right? Above and beyond. You know where this 2% came from? Do you happen to know?
Oh, this was something in New Zealand, some kind of
like a
guy
TV show,
that at
like a finance minister.
Yeah.
They kind of said, we have like a bit of a target, I don't know, let's say 2%. And that's how it came about, right? There's no.
Yeah, he just pulled it out of his pocket at a whatever press conference or TV.
Exactly. So there's a bit of anchoring on this 2%, by all means. And obviously once you think about central banks, effectively what they want to do is reduce interest rate volatility and stabilize the market. That's pretty much their objective. And obviously the question is, and we've seen that over the last 1 year or so, how much can they hike before that becomes a growth shock? Right. This is really
so far 5.5%.
Exactly. And are we going down? That's the good question. And the anticipation was yes, but it doesn't appear to be the case. Using the most recent news. So it's hard to make the call, right? I think it's hard to make the call.
Yeah.
Eventually, where this paper is going is that obviously acknowledging the dynamics between inflation, growth, asset class performance, but ultimately diversification in balanced portfolios or lack thereof. And what they put forward is, obviously they show with data, it's obviously simple algebra, that when this correlation kind of increases, the risk is going up and the return is most likely falling if you want to maintain the same level of risk because you have to reduce participation in equities. And they go about and say, okay, what can we do? So it's no surprise. We're going to go back now to the point that we started a conversation on, and they look into alternatives and how alternatives can help equity bond portfolios. And no surprise, obviously, one of the 2 or 3 strategies they come up with as potential diversifiers is trend following. So they talk about illiquid alternatives. They talk about obviously commodities, because obviously if inflation shock is primarily the one that is determining this equity bond correlation and the breaking into a positive territory, commodities can benefit. But trend following and long short equity and risk premia strategies are those that they kind of put out as potential diversifiers. But yeah, trend is one.
Let me interrupt you there because I did notice their list. Illiquid alternatives such as private equity and stuff like that, commodities, long short equity, and dynamic strategies like trend following and macro. When I looked at that list, I have to say I was pretty skeptical about a couple of them. I mean, illiquid alternatives, the only reason why it kind of dampens things is because it's never priced.
It's return smoothing,
not very often.
It's return smoothing.
It's return smoothing, right? So to me, that's kind of not something that gives me a really warm feeling if that's how I have to reduce my volatility. Because one thing they mention, and I think we should highlight that, of course, they do some pretty good research like you guys do. Something that I had no idea would be the case. And of course, this is an approximation. But they say that if the stock bond correlation goes from minus 0.5 to plus 0.5, the 60-40 portfolio gets 20% more volatile. That's not insignificant. And so, yeah, you're right. The aim, of course, is to try and dampen that. But anyways, the liquid alternatives, I thought, I don't think that's a great idea.
But in all fairness, they do say as well, right? They do say that, the diversification potential is very limited, right? Because obviously you acknowledge that, whether it's private equity or private credit, it's still equities and and bonds, right?
No. They're right in mentioning it. It's just I'm personally saying, well, it's not the route I would take. Then they say commodities. And, frankly, I think it's such a logical thing. And then when I think about what actually happened the last 12 months, I'm thinking, well, maybe people should be cautious because we go into the Ukraine situation, inflation explodes, everybody thinks that commodities are going to the sky, and what do we see? Well, they all sell off pretty significantly. whether it's energy, whether it's grains, whatever. So I think there is a danger in putting too much weight on a static or a predictable reaction from commodities per se. And by the way, I mean, you probably know this a lot better than I do, but from eyeballing charts over many decades, I seem to feel that many commodities in a 30-ish plus year cycle spend 10% going up, 10 years going up, but 20 years going down, which is also why long-only commodities and all these indices that were launched by Jim Rogers and people like that haven't been great for investors who bought into that thesis. So I think commodities are wonderful. I just think long-only commodities is something that I'm skeptical about as a true diversifier. I know we're pinning down to one of those four choices that I really like. So anyways.
The one thing I would say about commodities is that, we did some work with regards to inflation and growth dynamics and connection with commodities, and obviously setting aside the mechanical relationship between the actual number that we quote as inflation, that obviously incorporates energy prices. The link, even if it is statistically significant, in other words, commodity prices rising together with inflation or inflation rising together with commodity prices, one brings the other almost mechanically, there is some interaction with growth. And if we think about rising inflation and rising growth, this is much more of a pro environment vis-a-vis a falling growth and rising inflation. In which case, primarily typically the more industrial metals do not outperform. So it's more like on the energy and the precious metals that you would see, at least historically in relative terms, better performance. So it's not just by rising inflation. I think the interaction with growth is key, which takes us back to the equity bond correlation. So the equity bond correlation breaking and becoming positive, that is the time that not all of them go up. And it's primarily energy, I would say, and precious metals. Of course, you might tell me, okay, let's look at gold over the last 1 year. Well, then we had like the dollar thing. So I think it's a convoluted discussion, but I know there is a fundamental link there, or mechanical link in the first place. But we have to be more careful. That's how we look at it.
My other concern about all of this is that I just feel that the world is changing in ways we haven't seen before, and including kind of where inflation will come from. I mean, we have demographics that are changing dramatically, and I don't mean just in numbers, but also in attitude. And I wonder if we're looking at a slightly different scenario, or not just slightly, but a very different scenario, meaning that a lot of these models, I guess that's what I deep down feel. I think a lot of these economic models that people are using may not work as well in the future we're running into as they have in the past. I think just things will be significantly different. Anyway, that's a different discussion, Nick. Feel free to comment on it in a second. I just want to say, long short equity, I'm not smart enough to figure out whether that's a true diversifier from that point of view. What I have always felt, and this is kind of my simple way of thinking, and that is, well, if you want diversification away from equity, why do you want to invest in the same underlying, just call it long short equity? Now, of course, I realize that it's not exactly the same as long only equity, but it's still equity. And so that's just my naive, uninformed view of this particular strategy, I'm sure. Which leaves us with dynamic strategies like trend and macro.
There we are. Now, the few little things I would say, starting from the kind of the last point on the equity, I would expect that here we're thinking about equity market neutral strategies. So in other words, completely isolating the kind of cross-sectional differences between stocks while at the same time minimizing the beta. I would imagine that's what we're looking at. On the commodity side, I agree with you. Demographics are changing. There's an aging population. The world is becoming more inflationary just by the nature of it, just by the fact that we grow older, and the bulk of the workforce is kind of shrinking in a way. The other thing that I think it's quite important, specifically for the commodities, and now you're also touching a place that I'm spending more and more of my days over the recent year. It's this whole green transition dynamic, and how obviously we're shifting into the electric vehicle or the renewable energy, and then obviously there are now other physical commodities that become more and more important, obviously with limited supply, and anticipated excess demand, whether that is, lithium for batteries or like aluminum, which by the way is quite costly to produce. So then you have to kind of balance out, like how much do you pay to produce and how much gains do you have from going more environmental. So I think there's a few dynamics in place over the last, I guess, decades, and in anticipation of what's coming next, that I don't disagree with you. There are shifting dynamics that will make some of those notions of inflation possibly worth reconsidering or redefining. But that brings us to trend again.
Well, it brings us to trend, and it brings us to kind of the conclusion of this paper as well, because I wanted to follow up with a couple of questions before we jump to the Transtrend paper. But kind of wrapping it up from the papers, from your point of view, Nick, what are you left with?
What I'm left with is that we've seen 30 years of pretty much the same regime. Negative equity bond correlation and an inflation growth mix that have been very accommodative. I'm just trying to look into some stats here. Over the last 50 years, 50% of the time, based on some definition of growth and inflation, has been a rising growth, falling inflation. And if I were to look into the last possibly 20 years, this is probably 80%. And if I now look into the last year and a half, we went from rising growth, falling inflation to rising growth, rising inflation, first half of last year. Then we went into falling growth, rising inflation during the summer. And then we've been, since November onwards, on a falling growth, falling inflation. So we have seen significant shifts in that mix. And that mix obviously is primarily driven by inflation, obviously geopolitics and so on and so forth. But I'm seeing a much more volatile macro environment, which in my view requires much more prudent, possibly dynamic asset allocation decisions. And this is also work we've done as to how we incorporate inflation, growth, possibly more now casting indicators into the way that we allocate on the beta side. And most importantly so, diversifying sources on top. So I think if it wasn't too obvious before, and possibly now go back to the points that Andrew was making, it starts becoming more and more obvious. Even because the macro environment is volatile, or because the equity bond correlation turns into positive, or because we have inflation spikes or inflation shocks, the asset allocation story is shifting dramatically. That's what I'm left with. I think I've seen more papers on equity bond correlation the last 2 years than I've seen over the last 20.
Yeah, no, I completely agree. And actually, we were fortunate enough to yesterday record an episode that's going to come out in a few weeks with one of the brightest people I've ever come across, which is also one of your colleagues, the head of asset allocation research at Goldman Sachs, Christian Müller-Gliesman. And that is an awesome episode, and everyone should tune into that when it comes out in a few weeks. Now, just as a little observation, and of course I can see you physically, so I'd love to see your reaction to this. I don't know if you noticed in the news, but there's a recent interview that came out yesterday, I think, with Ray Dalio. He was attending, I think, the Milken Institute Asia event. And the headlines from that interview is that he doesn't want to own any bonds at this stage. And I stress any bonds at this stage. He wants to be in cash, which of course previously he didn't share that view, but now cash is better than even bonds. It's an interesting comment coming from someone like that, but more for me at a time where bonds have come off quite a bit at this point in time, at least in price. I don't disagree with him necessarily, but it's just an interesting comment. I don't know if you noticed it. The other thing I just want to mention from the news that I picked up was actually that Nassim Taleb was on Tim Ferriss's podcast this week or last week. And it was very interesting to hear him defend Universe's way of calculating their 4,000% return back during COVID and other things. It's a good conversation. Very interesting. You may not have heard it.
I did not hear that, but on the point on holding bonds, the one thing I would say is I did not read it. I've seen it, but I have not read it. did he actually mention horizon? Because
I don't think he did necessarily.
I'll tell you where I'm coming from, because now you remind me a story. There's a very nice book by Tetlock that is called Super Forecasting. He goes about describing how we typically produce forecasts and how, unless we specify probability and horizon, our forecasts are always correct. If I tell you it might rain, if it does rain, I will tell you, yeah, of course I told you it might rain. But if it doesn't, I told you, yeah, of course I told you that it might, but it wasn't like 100% sure, right? And then if I don't even specify the horizon over which I'm making that forecast, it's even harder for me to be assessed as a forecaster. Even more so, there have been, I think, a few like social experiments. What's the probability you associate to likely or probably or might? And we tend to use this kind of language when we write research reports or when we speak to the media and so on and so forth. But unless we really specify the time horizon and possibly the probability, we can never be proven wrong, right? So I think the challenge here is more about whether not holding bonds is prudent in the next month or 2 or 3 rather than outright. And I think that's the hard. That's a hard point in the assessment, right?
It's a great point, and it's obviously completely correct and relevant, and that's something that we often don't hear. It's like when people were talking about when we had this Bitcoin sort of crazy period, and people got so excited when they heard that some of these big, well-known hedge fund managers had bought Bitcoin, right? And I was just thinking, well, you should know that these guys are the first ones to sell it as soon as the price starts to go down. And of course, that's exactly what they did. Anyways, let's jump to the other paper that we want to talk about from our Dutch friends, Transtrend. They wrote a paper called The Fruits of a Diversified Approach. And it touches on a number of topics, and you can kind of dive into where you want. They talk about whether certain markets are better traded as by specialists or by CTAs. And they talk about kind of the impact that order flows may have. And then it gets interesting, because then they start talking about what really drives performance in a CTA program, whether it's correlations or whether it's the trading activity. So I would love to hear your thoughts on their findings and their paper.
Yep, absolutely. And I think the last point that you made on what is driving performance and dynamic position sizing, that's the one I kind of relate the most with. So I'm going to get to that. But they start the paper, I think finally they start the paper by how we started our conversation today, because I think they mentioned something along the lines of, should we hold equities in trend following, specifically hold long equities, because we're actually holding long equities elsewhere? Or should we hold higher yielding currencies? Because then if that is what we're doing, then it's almost like more like a long carry portfolio. So they kind of go about and say, are we basically the specialist in those markets? Well, not necessarily in those markets. And you can have the specialist doing, your stock selection beta portfolio, or your kind of global macro doing your, currency allocation. But what we're more specialist on is bringing everything together from different asset classes, monitoring signals, but then having a prudent portfolio construction engine that allows us not only to capture those conditional trends, but more importantly so, do the fine adjustments in a dynamic fashion. And that is part of, I guess, of the, should I call it alpha? I don't know. This term has been used in this show so many times. And I think the more I mention it, the more I'm going to open up.
Dynamic alpha. Let's call it dynamic alpha.
Kind of worms, but this is the place in that write-up that I kind of found a bit more interesting and quite engaging, because the first time you read through, you're like, wait a second, because I'm going to say basically what they're saying, which seems to be a bit counterintuitive. They say at some point that, with falling prices and excessive falling prices, they end up buying into the asset as opposed to just continue shorting, which you'd expect a trend following manager to do. Or they say, with significantly uprising prices, they end up starting selling. And you're like, wait a second, are you doing trend or are you not doing trend? And obviously, the moment you start reading through again and you put all the pieces together, it kind of makes sense. And I think this is a point I had made, I believe, in the first time that we got together back in November, when you were asking me, if you remember, about crowding and whether CTAs are reinforcing down moves and so on and so forth. And I remember making this particular point being precisely because trend followers vol scale the exposures at the asset level, a falling price, which is typically associated with a spike in vol, is going to lead to a smaller signal the more down the price goes, because the more the price goes up. And therefore, you might be holding 10 units short, and then the next day you might have to hold only 8 units short because the vol went up, and obviously your vol scaling tells you to reduce your gross. So, but going from 10 short to 8 short, you have to buy back 2. So this is the point whereby, yes, you still continue on your down path because your signal is negative, but your gross exposure drops. So you end up kind of buying back and almost crystallizing the gains. The opposite to it is, for example, last year, we know with the commodity moves, those spikes in March were very volatile. So, symmetrically, you would reduce the exposure as in start selling on the way up. But also it happened in a very high correlated fashion. And I believe the paper also talks about this particular moment. And you wanting a diversified portfolio in a dynamic fashion, you penalize clusters. So the more correlated assets become, the less you'd want to hold them. So here's now a very mechanical, yet quite, I think, intuitive way to understand their point. Point being, in excessive market downturns, there is a point that we start buying. And by the way, if there is a crowding comment to be made, that is actually anti-crowding. You're supporting the market as it falls because you start buying. And conversely, on the upside, correlation and volatilities would end up possibly leading the portfolio, switching risk budgets in ways that you end up selling rising prices. And I think that's their point, which I found quite interesting because I am a believer. I think we've discussed quite at length here of dynamic position sizing. So pretty much aligned with my way of thinking. And we can take the discussion elsewhere as to whether this is pure trend or adding a few more reversal signals and so on and so forth. But I'll pause here in case you have any comments.
Yeah, so what are my thoughts on that? My thoughts are that what you're describing there is absolutely correct. And I think if done well, I think it is a very effective way of managing a portfolio risk, for sure. It leads me to a question, though, and that is what I took away from their paper was that they feel that a lot of the quote-unquote alpha comes from this trading activity. And then I would then ask myself, well, if that's the case, then that should mean that managers with dynamic position sizing should have an advantage and should outperform those of our friends who are not quite there yet. But that doesn't seem to be the case either, really. Over certain periods of time, maybe. In the long run, debatable. Maybe it's also regime dependent, of course. At periods of time where there's huge trends, of course you would expect the non-dynamic guys to maybe outperform and vice versa. So, but I've often said on the podcast when speaking to some of our friends who don't dynamic position size that because they say their method is better, and I say, well, I don't see that in the data. So now that we are presented with the opposite view, I kind of have to stick to my story in the sense that, well, I don't think overall you could say that that's better, but there will be managers that simply are better. I do believe in that. I think there are managers that have just a little bit more skill, if I can put it that way, because otherwise everyone would perform the same, which they don't. So anyways, those are kind of my reactions to what you described and what the paper describes.
I mean, I would agree with you on the point that dynamic position sizing. I would not think of it as the largest part of the alpha, whether that is performance or skill. Because I think I shared my views here that alpha is not objectively defined. Alpha could be numerically the intercepts in a regression. That's where it came from, but we now heuristically use it for differentiated skill as well, and this is less quantifiable. But anyhow, I think dynamic position sizing is more about prudent risk management, in my view, and that is not to say that those that do static position sizing do not risk manage their portfolios. It's just that my personal view from building and maintaining those portfolios on behalf of our clients, we would want to deliver relatively balanced risk profiles that reflect not just volatilities but also correlations. Because ultimately, clustering of assets, back to the point we're making on equities and bonds, there are those linkages that go way beyond just a tagging of, oh, that's a commodity, oh, that's a rates instrument, that's an equity. So that's how I see the dynamic position sizing. If I were to say. Now, the other points that I would make, which kind of go beyond trend, and this is some work we're doing at the moment, and I believe we discussed in the very, very beginning back in November, is how we see trend following beyond just pure trend. Because somebody can say, well, you know what? If this market keeps on kind of falling, why do you buy it back? Are you really acting upon trend or you're acting upon other things? And is that implicit reversion you're achieving by selling the market, a trend function response, or that's another signal you're kind of bringing in? And by the way, this is some work we're doing, by looking into other sources of returns that we can have in the cross-site space. I can happily go in that direction if you want me to go, but possibly you remember we discussed some reversion signals or some carry signals. So I think there is value in this aggregation, but that goes beyond just pure trend, right? And it's unclear whether the vol scaling in some respect, I guess you can see me kind of waving my hands here, but masks a reversion signal. It could be the same thing in a way, right? And I think there is value, not in pure trend, but in pure trend, but plus adding stuff. Right? I think there's also value exploring that territory, specifically for years like this one, which has been an okay year, but not a blockbuster, where you see more carry sources or reversion dynamics kind of playing out.
Yeah, no, absolutely. For sure. I mean, I've always felt that these strategies will perform differently, but it's just hard to say whether one can consistently outperform the other. I think that there is too much in what you said that we can unpack in the last 5 minutes that we have. I think actually the third paper we wanted to talk about, we may have to keep as well as a little bit of a secret for next time. Okay. Unless you feel you want to just talk a little bit about it. Because that's one of those papers that I only kind of skimmed through. I saw all the formulas in the paper and I thought, that's for Nick. That one is for Nick.
No, okay. I mean, I can give you like a very, very quick overview. Even myself, I haven't found the time to look at it in great detail. So this work came from the Oxford Money Institute. This is the research center that sits in the Oxford University, obviously with the collaboration of Money HL. And they typically put out very, very good work. They try to blend from time to time new numerical quantitative techniques by the likes of machine learning and so on and so forth in the systematic investing space. So this time around, they came up with some work. I know this was posted online on the 14th of August, I can see here, so like literally a month ago. And the paper is called like Network Momentum across asset classes. So what is network momentum? The whole idea of kind of momentum spillover has been in the literature for years. How a stock of a company is predicting the corporate bond performance of the same company, or how we can look into kind of network effects between stocks. And I'm a mobile manufacturer, but the more I perform or the more I sell, the more I anticipate the company that's building the screens, or the silicon chips, or the chargers, or whatever that might be, will also benefit from the network effects and the fact that there is a kind of demand for goods to be repackaged into a final product. And there have been papers written on those, but once you look into a universe of a trend follower, which is more about macro assets across asset classes, there is no kind of company level data that somebody could use. And what we typically do is that we enforce some correlation structure, which is primarily driven by some sort of long-term correlation analysis or possibly informed by our own tagging. Oh, that's an equity. Oh, that's a bond. But what do you do with, Italian bonds? Is that credit that kind of resembles growth risk, or that's like a duration asset? So what they go about is to say, well, how about we just forget about tagging assets and instead, we ask the data to speak by themselves and we build graphs. And graphs come from the machine learning literature, effectively connecting assets and creating central nodes of energy, quote unquote. And they go one step further and say, well, if there are those linkages, then I can hypothesize that asset A is going to start building momentum if the assets that is connected with start building momentum themselves. And I can obviously weight those momentum signals, with the weights of, as we say, the tightness between the various assets between each other. And I can create a generic signal at the asset level that is, instead of being its own trend, it's nothing more than the aggregation of neighboring assets that are connected in this kind of graph network. That's pretty much what they do. So I think it's an interesting idea because you're still doing some form of trend following. So the nature of it is there, but the generation of signals is very different to a univariate movement. And possibly, and I need to look at it in greater detail, possibly there is a case to be made on an asset not trending per se, but the activity around it predicting that it's going to trend. So you don't have the ability to see the price moving before it starts moving, but you can somehow predict it's going to move because the rest are actually moving. In the same thing that, hey, the more screens I sell or the more chargers I sell, the more I can predict that whatever those things will be backwards in will start selling in a way. So I think it's an interesting idea. It came out, and I think at least our get-together deserved at least a mention.
Absolutely. No. I mean, as you say, they do some great work, so it's worth paying attention to. Maybe we'll come back to it at a later stage. Maybe we'll find some completely different thing to talk about next time you're on. In the meantime, Nick, as always, I appreciate your insights. And if you, the dear listener, also feel that this is definitely worth your time, perhaps you know a friend or two or five that might also be interested in what we're talking about on our little channel here. So please go to toptradersunplugged.com/review. That will give you the instructions to leave a rating and review of the podcast. And of course, we would also appreciate if you would share these episodes with your friends and colleagues. Next week, I am joined by Alan. So that will be another interesting conversation, probably some global macro themes, I can imagine, maybe some allocation themes, maybe some trend following themes. It will be wide ranging, no doubt. And should you have a question for Alan, then send it to info@toptradersunplugged.com and I will do my best to prompt him. From Nick and me, thanks ever so much for listening. We look forward to being back with you next week. And until next time, take care of yourself and take care of each other.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.